TD Bank stock coming under some pressure in today's trading session. Take a look, down 1 2/3%. Coming after the bank's latest quarterly profit beat analyst expectations. Also news of a $668 million deal to acquire Epoch Holding Corporation. It seems investors are worried about the company's higher expenses and a slowdown in mortgage growth and a stalling economy. So let's talk TD Bank and what that means about the broader economy and you. Joining me now is CNBC exclusive TD Bank Group CEO Ed Clark. Ed, always wonderful to have you on the program. Thanks for joining us.
Terrific to be back here again.
Let me kick it off with the results. The stock, of course, under pressure. I know you're not a near-term thinker, but what do you think is most concerning here? How was the quarter?
Oh, actually, we were very pleased with the quarter and really pleased with the year. You know, we went into the year saying we were going to get hard. It was going to have to work really hard to get 7% earnings growth. We ended up with 8 earnings per share growth and 10% overall growth. So it's really actually, you know, we faced a lot of headwinds this year, Durbin Amendment, obviously lower interest rates, lots of things going on. So frankly, we're very pleased with the year.
And of course, you announced this acquisition of Epoch. Why do this deal now? Tell me what this does to the company and what was so important in terms of contributing to business.
Yeah, so, you know, we have signaled to the market for some time that what we want to do was a small asset manager, had the right kind of quality of people and the right culture. And Epoch just fit absolutely perfectly that. It's just one of these, you know, great firms. I think if you test in the market, they'd all say these are incredibly high quality people. And so I think what we can do is have a partnership in effect with them. I mean, they're going to be independent. We don't want to change that culture, but what we can do is feed them business so that they can grow even faster than they would have grown without us. So we're just delighted. It obviously adds capability because we're going to be building out our wealth strategy to go along with our bank in the United States. And this is a critical element of having that capability.
Ed, how are you preparing for the fiscal cliff if we go over it? What's your take?
You know, I guess, if I can say something, I guess politically incorrect. I think all CEOs are supposed to wring their hands and say this is terrible, it's all going to collapse. But I think I make the distinction of whether you go over the cliff and whether you stay over the cliff. And so I think, you know, the way that politics seems to work is you have to have a little bit of pressure for people to, in a sense, compromise. And that may mean, hopefully, it would be better for the economy if they could get this deal done without going over the cliff. But, you know, frankly, it may be that they'll be over the cliff for a few days, and the market would obviously put tremendous pressure at that point. I think in the end they're going to get a deal, and I think that's what makes me optimistic about America, because I think in the next 4 or 5 years, America can outperform and surprise people on the upside.
What are you seeing in terms of business these days, Ed? For example, the mortgage business. I mean, are you against taking that mortgage deduction out of the list of loopholes and exemptions that could be cut?
Yeah, I guess I have to say, as I think the right public policy, it would be better to get higher revenues through capping some of these deductions than raising the marginal rates. I think in the end we're going to have a combination of the two, probably not raise them as much as originally thought, but also cap. And I do think that fundamentally a cap on mortgage interest deductibility would be a good public policy measure, even if that means some slowdown in the mortgage volume growth. You know, sometimes I think banking leaders have to think about what's the right thing for the country and then worry about how they make money in that rather than just what the right thing is for the short term for their bank.
So what are you seeing right now in terms of mortgages? Do you believe housing has bottomed?
I think housing has bottomed. We have tremendous volume. We have 30% plus growth in mortgages. So our overall loan book this year in our U.S. bank grew 16%. Our deposits were up 8%. Our earnings were up 10%. But I think we're a little unique in the sense that we're clearly taking major market share every week, every month in the United States because of our sort of advantageous offering. And I think that's going to continue to grow, even if the mortgage market slowed down.
All right, we'll leave it there. Ed, it was nice to have you on the program. We so appreciate your time tonight.
Terrific. Thank you very much.